Hi folks, welcome to Module 4.3's lecture where we're going to talk about the General Journal. Again, the General Journal is basically where we begin recording our ongoing transactions inside of an organization. So what typically happens is a transaction is going to occur and a source document will be provided. A source document could be an invoice, a receipt, any sort of form that proves that a transaction has occurred. We receive that source document. The next piece is that we're going to actually analyze the transaction. So we'll try to understand what's going on here, what accounts are affected, and what amounts are involved. This general journal is sort of an ongoing record. If we think about it as sort of a personal journal or diary, we sort of record the ongoing transactions of our day on an ongoing basis. There's no real rhyme or reason to the topic matters. We just kind of record as things happen. Very, very similar in the general journal. We culminate these transactions typically on a daily basis, and all the transactions are kind of jumbled together into these journal entries, all kept separate per transaction, but we basically just keep track of what's going on from day to day. This is an example of what a journal entry would look like. So a couple of key highlights here. Every journal entry starts with the date, typically on the left-hand side of our journal. We have two accounts, or sometimes more than two accounts, and we have both the debit and credit. So we're going to record our amounts as either increasing an account or decreasing an account and the corresponding debit or credit from our last conversation. And so again, we'll indicate the account that's involved, the amount that's debited. Our debits come first. And then our credits come second. And again, our credits over here. We have our account listed here. And typically in our journal entries, we indent our account, our amounts here. So both our dollar figure and our account are slightly indented to indicate that it's a credit. And last but not least, we'll indicate a description of the transaction so that as we go back, we can understand what happened here. Okay. We may also have a reference to the source documents. So, you know, invoice 1234 paid by customer might be an indication of the transaction we're looking at. Okay. It's also important to remember that our debits must equal our credits. So for every transaction, we're going to have what we call a balanced entry. The total amount of debits should equal the total amount of credits. Let's do a few examples here. So if we have ABC Company, and they pay cash for $500 of advertising in a local newspaper on July the 5th. So first we want to start off with what transactions has occurred. So we'll start with transaction analysis. So what accounts are affected? We have cash, and we have something called advertising expense. All right, let's think about the types of accounts that these are. So cash is an asset, as we know. Advertising expense, of course, is an expense. We want to think about what's actually happening here. So we're paying cash out, so we have a decrease in cash, and we're adding to an expense, so we have an increase in expenses. And we'll think about what transaction, debit or credit, is going to increase or decrease an asset, and so we know that this is going to be a credit, and an increase to an expense is going to be indicated by a debit. And we know the amount, $500 all around. So now we can do our journal entry. So again, our general journal entry, typically set up in a format that would have debits and credits listed on the side here. We start with our date, July 5th. Always start with the account that we're going to debit. So in this transaction, we have advertising expense and the amount. We indent slightly to our credit, which is going to be cash in this case. There we are. And then we'll put in a description. paid for advertising in local newspaper. Invoice number 624, for example. Okay, so again, let's highlight some of the key elements of these journal entry. We have a date, we have a debit account and an amount, we have a credited account and an amount, and remember we indent that credit slightly, and we have a description of the transaction. So let's try the next one. You might want to pause this for a moment and try it on your own, and we'll look at it together here. So November 12th, we have SMU Corp that sells $3,000 worth of services to Joe Smith, a customer, on account. So let's just stop on an aside and review what on account means. We're going to hear this term on a fairly regular basis. And anytime we hear on account, what we're really saying is they owe us. Okay, so we sold it on credit, in other words. So again, our first step will be transaction analysis. So what accounts are involved? Let's take a look. We have $3,000 worth of services to Joe. So we're selling some services, so we'll likely have to record those as service revenue. And we have a customer who now owes us money. We know that when customers owe us money, we typically call those accounts receivable. We'll mark it as Joe Smith so we know who owes us that money. Let's think of the type of account we're dealing with. Service revenue, of course, sounds like a revenue account. Accounts receivable, if we'll recall, is an asset. Now let's think. We've generated more revenue, so we have an increase in our service revenue account. And we have an asset. A customer owes us money, and it's going up. He owes us more money, or we have a new customer that owes us money. So we have an increase here. If we think about how that's established, we know that an increase to a revenue is a credit, and an increase to an asset is a debit. Okay, so let's move on to our second step, which is to journalize it. So again, we'll start with our date, November the 12th. Start with the account that we're crediting, account receivable, Joe Smith. You'll note that the indication AR is what we'll typically use for accounts receivable as a short form for $3,000. And our credit will be service revenue, again for the same $3,000. And over here, sold services on account to Joe Smith, terms 210 net 30. So again, we're going to indicate the type of transaction we had in our description. So we sold services on account. Anytime that we sell something on account or we set up an account receivable, there's typically terms that come along with that. So we are indicating here that we want Joe Smith to pay us back within 30 days. That's where we see this net 30. And 210 is going to be a discount that we might provide him if he pays a little earlier. Don't worry too much about those terms of credit right now. We're going to deal with them again in a later chapter. But important to sort of understand that anytime we set up credit with a customer, it's important for us to outline the terms of that account receivable. It's not that we're just providing services, sending an invoice, and saying, pay us when you have a chance. We typically set up some terms so that the customer understands what the expectations are, and we'll have an indication of when we should expect to receive that cash for him to pay us back. Okay, so that's our second journal entry. Again, we have our date, we have our account that's debited, our account that's credited, slightly indented. The amounts, again, debits equal credits, and we have our description of the transaction. The most important element, I think, of these journal entries is step one. We actually analyze the transaction and figure out what's going on here. And then the second will be to put it in a format that we can follow along. Okay. Last but not least, August 29th, $800 of rent is paid in cash. So let's start with transaction analysis. What accounts are affected here? Well, we're paying something in cash, so obviously cash is impacted. And we're paying rent, so we'll have an expense that we call rent expense. So again, we have an asset, and we have an expense. Our asset is going down, we're paying out cash. And we're incurring additional expenses, so our expenses are going up. And we recall that when we have a decrease in assets, it's a credit, and an increase in expenses would be a debit. Next, we're going to journalize this. So we have our date, August the 29th. Start with our debit, rent expense. Our amount, $800. Indent our credit. Again, we're crediting our cash account for $800. Okay, and paid rent for the month of likely August. Okay, fantastic. So that's an introduction to our journal entries. Continue to work through some of the exercises, and we'll do a few more examples in our weekly tutorial. Thanks so much, and hope you're having a great day. Take care.